term assurance plans. So what are term assurance plans? Here in such a type of plan, the sum assured is paid only if the insured dies during the term of the policy. There is no survival or maturity benefit payable here. It is the cheapest plan available and it is actually the true form of insurance. It is normally applicable for low income, high insurance needs. It is generally taken for mortgage protection, or it can be seen as a hedge or protection against a speculative investment, etc. We have a concept here known as BTID. We call it as buy term insurance and invest the difference. The logic is we should segregate insurance and investment. So a person can take term insurance for insurance purpose and he can invest the remaining amount in an investment product, like it can be a PPF or it can be a mutual fund or it can be a stock market, etc. So this is what we call as BTID. So let us understand the different types of term insurance in the coming videos. Term assurance plans types. So let us start with decreasing term assurance. It is a special type of term assurance. Here we have two types: mortgage redemption insurance and credit life insurance. In mortgage life insurance or mortgage redemption insurance, generally used to cover housing loans. Here the insurance is arranged such that the amount of death benefit or the sum assured at any given time equals the balance of principal owed. It means that as the time passes, the death benefit slowly decreases, and at the time of maturity, that is at the time the EMI is over, that is the housing loan term is over, the sum assured will also become zero. That is the concept in mortgage redemption insurance. The second form is credit life insurance. Here this type of insurance is used to pay the balance due on a loan. Generally this type of insurance is given as a group insurance cover to the lending institutions to cover the borrower lives to the lending institutions. Term assurance plans types part 2. We have increasing term assurance. Here normally the death benefit or the sum assured usually increases over passage of time. It is normally linked with a particular index like life index or inflation index, etc. Here the premium also increases gradually. Here we have one more type of term insurance. We call it as term insurance with return of premiums. Normally the true form of term insurance, in case of true form of term insurance, premiums are not repayable, but in term insurance with return of premiums, once the term is over, if nothing happens to the insured, if he survives the term, then the entire premium paid by the insured is repaid back. That is what we call as term insurance with return of premiums. Of course, here the premiums are higher than the normal term insurance policies. And we have the last type, we call it as convertible term insurance policies. Here we can convert a normal term insurance policies into a whole life term insurance plan, whole life plans.